Okay, our topic as a continuation for our discussion series for trade and other receivables. We'll be discussing note receivable. Our focus points for this discussion, we have to discuss definition, or we have to define notes receivable, characterize what is notes receivable, classify uh, receivable, measure notes receivable, and for the FS presentation. And if time still allow us, we can discuss accounting for interest-bearing notes receivable and non-interest-bearing notes receivable. Okay. So let us define notes receivable. Notes receivable is defined as a financial asset. Okay, all receivables are actually financial asset. So for notes receivable, it is a financial asset that gives a company a contractual right to receive cash or another financial asset in the future. Notes receivable arises when we have transactions that involves the receipt of promissory notes. So for example, if we have transactions with customers, if the customer provides us with promissory note, that promissory note is an evidence that we have a receivable from that customer. So example of transactions that might involve receipt of promissory notes, we have sale of goods, sale of services, we also have sale of properties, and lending of money to others. When we say sale of goods and sale of services, we are referring to usual activities, trading activities, buy and sell activities of an entity. When we say sale of properties and lending of money to others, this refer to activities that are non-trade, or those activities that do not involve engagement with customers. They are usually arising from parties other than the customers. Next, we characterize notes receivable. A notes receivable, again, is a financial asset under the general characterization of a receivable, so financial asset. Another is from written contracts of promise to pay. When we say from written contracts of promise to pay, the proof for notes receivable is the promissory note. The presence of the promissory note itself, it is a written contract of promise. Secured claims, because again, the presence of the promissory note, it is our evidence, a written evidence that we have a receivable from another party. With maturity dates, unlike with accounts receivable, notes receivable have maturity dates. So there is a specific period within which we can, upon maturity, we can collect the entire amount of the notes receivable. So again, we have financial assets from written contracts of promise to pay, secured claims, and with maturity dates. So for classifications, we classify notes receivable either as to nature, as to maturity, as to purpose, and as to FS presentation. Let us start with as to the nature of the notes receivable. The notes receivable is interest-bearing if the note bears interest separate from the principal amount. The stated interest is the rate that we're going to use in computing for the related interest. So we are basing the computation of our interest with the so-called principal amount. Then we have non-interest bearing. When we say non-interest bearing, it is in contrast with the interest bearing. It does not necessarily mean that the notes receivable does not involve interest. Rather, in contrast with an interest-bearing notes receivable, if interest-bearing notes receivable bears interest separate from the principal amount, non-interest-bearing, on the other hand, it also involves interest, but the interest is already embedded as part of the face value of the notes receivable. For interest-bearing, the face value is the principal amount. For the non-interest-bearing, the face value is both the principal amount and the interest already. Second, we have as to maturity. We have it short term first. When we say short term, if the notes receivable is collectible or has maturity of less than or equal to 1 year. Then we have long term. When we say long term, the notes receivable is have maturity of more than or beyond 1 year. Okay, so as to maturity, it is actually related to the FS presentation of the notes receivable. As the purpose. So as the purpose, first trading, if the notes receivable is arising from ordinary activities of the company, meaning engage with activities with customers, selling goods or services to customers. So that is trading. Next, we have non-trading. If the notes receivable is arising from other transactions than the ordinary activities of the entity. So we have incidental activities. So if we receive a promissory note from a related party or other than the customers, then we can consider that notes receivable as non-trading. The difference only of trading and non-trading, trading always take note of ordinary activities, non-trading relates to incidental activities. And as to FS presentation in connection with the maturity of the notes receivable, we can have it first as current. When we say current, the notes receivable can be collected within 1 year from the reporting date. So for example, if our reporting date is on December 31, counting from December 31, within 1 year from December 31, we can consider the notes receivable as current. Otherwise, it is non-current if collectible beyond 1 year from the reporting date. So therefore, following its maturity date, if we count from December 31, if the maturity date or if the collection period required for that receivable is beyond 1 year from December 31, then we can consider that receivable as non-current. Next, for the measurement of the notes receivable, for initial measurement, for short-term notes receivable, we have it at face amount. As we have defined face amount, it is the value of the receivable at the date of transaction. So for example, if it is 1 million at the date of transaction, so that is the face amount for the notes receivable. So take note, for short term, it is the face amount. For long term notes receivable, we have to look into if the notes receivable is interest bearing or non-interest bearing. So for interest bearing, we have it at face amount. Okay, that is the general rule for the measurement for interest bearing notes receivable. Why? Because in connection with the definition of interest bearing notes receivable, that the face amount is always equivalent to the principal amount, or the principal amount is equivalent to the face amount. And separate from the face amount is the computation for the related interest. Then for the non-interest bearing, we have it at present value. We initially at present value. Why? Because as we have defined earlier, non-interest bearing notes receivable are those receivable that the face amount is equivalent already to principal amount and the interest. So again, at initial measurement, both short-term and long-term interest-bearing, we have it face amount. For non-interest-bearing, we have it present value. So concept-wise, that is the initial measurement for notes receivable. For subsequent measurement, of course, since notes receivable is a receivable, and we all know that receivables are financial asset at amortized cost, we generally measure receivable at the amortized cost. Okay, so for notes receivable, we also have it at amortized cost. For notes receivable, amortized cost means initial measurement, so we have the initial amount, less principal repayments. When we say principal repayments, all the collections that we have received. Then plus or minus an amortized difference between principal amount and maturity value, if any, then less uncollectibility losses. So that is amortized cost. Then for FS presentation, again, depending on the maturity, we have it first current, then we have non-current. Current is collectible within 1 year. or if according to PAS 1 or for our conceptual framework, we can also have it within the operating cycle of an entity. Then non-current if collectible more than 1 year. Usually, the operating cycle of an entity, if we're going to have it in the practical side, they follow the calendar year. When we say calendar year, operations starting from January 1 to December 31. So for interest-bearing notes receivable, a notes receivable is considered interest-bearing if it bears interest at a stated rate separate and based on the face amount or unpaid balance of the note. What does it mean by interest-bearing? If we're going to have it in Tagalog, yung principal amount nanganganak ng interest. Yun yung ibig sabihin ng interest-bearing. The principal amount nanganganak ng interest. So, notes receivable is interest-bearing if it bears interest at a stated rate, separate and based on the face amount or unpaid balance of the notes receivable. How to compute for the interest? Per the definition of the interest-bearing notes receivable, we have it there bears interest at a stated rate. Meaning, there's a specific rate that we're going to use for the computation of the interest. For interest-bearing notes receivable, on the face of the promissory note, you can determine if the promissory note or the notes receivable is interest-bearing or not if on the face, when you say face, on the contract itself, a contract of promise to pay, you can see there a stated interest. When you say stated interest, the interest that is provided in the promissory note. So to compute for the interest for interest-bearing notes receivable, it is the face amount or equal to the principal amount of that notes receivable multiplied by the applicable interest rate. The interest rate is a percentage based on the face amount of the promissory note. So again, the interest rate or the stated rate, it must be provided or present on the face of the promissory note. It is provided in the contract of promise to pay. For interest-bearing notes receivable, interest can either be compounded or uncompounded. We're going to compare what does it mean by compounded and what is uncompounded. Compounding of interest means the resulting interest also bears interest. So not only the principal amount will bear interest, also the interest. So if we compute interest from the principal, then for the succeeding period, the interest will also bear interest. We're going to appreciate it later if we have sample problem solving. So again, when we say compounding of interest, the resulting interest also bears interest. Okay, not only the principal amount that bears interest, but also the resulting interest. So it is computed as the balance of the notes receivable plus interest times the stated rate. We can have the computed interest for the current period. If the interest is considered uncompounded, therefore the interest every period is considered fixed. So therefore, in contrast with compounding, if compounding involves the interest to further bear interest, then for uncompounded, the interest no longer bears interest. So for our interest for the period and the succeeding periods will have the same or fixed amount. We can say that under compounding of interest, interest is not equal every period. But for uncompounded, interest is equal every period. For uncompounded, it is simply the balance of notes receivable multiplied by the interest rate. So the interest is fixed. And how to account for interest-bearing notes receivable? We have to compute with the maturity value. For interest-bearing notes receivable, the maturity value is computed as the principal amount or the face amount plus the total interest computed. So every period, we're going to accumulate all the interest then added to the face amount or the principal amount of the interest-bearing notes receivable, then we can have already the maturity value. When we say maturity value, the total amount that we can collect out of the notes receivable. How do we compute? The face amount plus the total interest computed. Face amount being the principal amount and the total interest, the periodic accrued interest. Total periodic accrued interest. So to record the receipt of the promissory note, we debit notes receivable, then we debit loss on sale if any, if the we debit only loss on sale and we credit gain on sale if we refer to transactions other than with customers. Then we credit sale if the transaction involves a sale of goods or services to customers, or non-cash asset and other accounts if related to non-trade activities. So a debit to loss on sale or a credit to gain on sale is referring only to non-trading. So if the receipt of the notes is referring to transactions with customers, then usually it is credited to the sales revenue account. And to record the accrued interest, we debit accrued interest or interest receivable. Accrued interest and interest receivable are just the same. Then we credit interest income. Actually, this journal entry is related to your adjusting entries that you have in your basic accounting. Usually, the accrual of interest is annual. But depending on when did we receive promissory note or when did we have the notes receivable, counting from that date, then we can arrive the amount of the accrued interest. But usually, problem solving provides for promissory note as received January 1 of the current year. So usually annual. Then to record the receipt of the interest, so we debit cash and credit accrued interest receivable. But there are accounting procedures that they may shortcut. They cut the process. What they do is to debit na lang cash and credit interest income. Okay, the most preferable journal entry. The resulting entry usually eliminates the debit and credit to the accrued or the interest receivable account, therefore eliminating the accrual of interest. And to record for the settlement of the notes, we debit cash, then credit notes receivable, and credit accrued interest, the total accrued interest. The debit to cash is the total of the notes receivable, the principal amount, plus the accrued interest. So the debit to cash is actually the maturity value. Let us have sample problem solving 1. So on January 1, 2020, Will's company received a 3-year promissory note for $500,000 for the machine sold with a book value of $440,000. The note bears interest. So our clue, if it is interest-bearing note, dyan. The note bears interest at a rate of 12%. Take note that 12% is per year or on an annual basis. The note matured and paid at the end of 2022. So prepare the required journal entries from 2020 to 2022, assuming interest is compounded annually, and number 2, uncompounded annually. So our face value of the notes is the $500,000, and we can consider the problem as a non-trading transaction. Why non-trading? Because the sale of a machine is generally not considered for ordinary activities unless our ordinary activity is relating to sale of machine. The assumption of the problem is that the sale of the machine is non-trade. So we can have here the involvement of gain or loss on sale. So solution for compounded, to record the receipt of the promissory note for January 1, 2020, we debit notes receivable for 500,000, credit machine of 440,000, and gain on sale of machine 60,000. Why gain on sale? Because we received more than what we have sold. We only sold for 440, but we received 500,000. So the difference is a gain on sale. To record the accrued interest. To record the accrued interest for 2020, since 2020 is the first year of computation of the interest, the basis of our computation would be the sole principal amount of 500,000. So 500,000 times 12% would be 60,000. So we debit accrued interest or interest receivable, then credit interest income. By the way, the problem involves a lump sum payment. Why lump sum payment? Because if we're going to go back with the problem, the note mature unpaid at the end of 2022, meaning the final collection of the principal and interest is at the end of 2022. So lump sum collection. So to proceed with 2021, because 2021 is the second year and subsequent to 2020, first year of computation, the basis of our computation for the accrued interest for 2021 will be the 500,000 plus the interest that we have in 2020. So times 12%, we have 67,200. As you can see, in contrast with the 2020 interest, accrued interest, 60,000. For 2021, we have now 67,200. So for compounded, we always consider that the accrued interest is not equal every period. Next, for 2022, the accrued interest is 75,264. The basis is the 500,000 plus the interest of 2020, 60,000, and 2021, 67,200. Times 12%, we have 75,264. So for the settlement in 2022, we debit cash, we credit notes receivable, and credit accrued interest. Notes receivable is equivalent to the principal amount, and for the accrued interest, we have 202,464. For the debit to cash, we have the total of this principal amount and accrued interest. The computation of the accrued interest, simply the total interest from 2020 to 2022, that would be 202,464. Uncompounded. So for uncompounded, we have an idea that all interest from the different periods will have fixed or the same amount. So for the receipt of the notes, we still have the same journal entry, debit notes receivable for 500,000, credit machine for 440, and credit gain on sale of machine for 60,000. So the same whether compounded or uncompounded. Then for the accrued interest for 2020, whether compounded or uncompounded, will have the same interest of 60,000 because 2020 is the first year of computation. The basis will be the sole principal amount. For 2021, we'll still have the same amount. Why? Because uncompounded. When I say uncompounded, the interest will not bear further interest. The same with 2020, we'll have 60,000, and for 2022, we still have 60,000. And for the settlement of the promissory note, the same, debit to cash for the total maturity value, credit to notes receivable for the face amount of 500,000, then the accrued interest of 180,000. How did we arrive at the 180,000? Yan. So that would be the total of the interest that we have for 2020 to 2022. So 60,000 plus 60,000 plus 60,000. That would be 180,000. So the total maturity value, a debit to cash of 680,000. So next, we have sample problem solving 2. For sample problem solving 2, in contrast with sample problem solving 1, sample problem solving 1 is related to a lump sum payment. But for sample problem solving 2, this is referring to an installment basis of collection for the notes receivable. Why? Because assuming January 1, 2020, Wheels Company received 3-year promissory note, 600,000, yung the face value, for the machine sold with book value of 520,000. The note is payable for 200,000 per year until 2022, and the interest is at 12% based on unpaid balance of the note. So in sample problem solving 1, the basis of our computation is the principal amount of 500,000 earlier. The 500,000 will be the unpaid balance. But for this problem, the unpaid balance will be a running balance, meaning 600,000 will be decreasing because of the payment of 200,000 every year. The basis of our computation will be 600,000 minus the 200,000, then so on and so forth. So journal entries required from 2020 to 2022. So for installment basis, we record the receipt. Notes receivable 600,000, face value, machine 520, and gain on sale 80. For the annual collection, debit to cash 272,000, credit to notes receivable 200,000, and credit to interest income of 72,000. Since we're going to collect both principal and interest for the installment basis, the notes receivable is credited to a principal amount of 200,000, portion of the principal amount, because every year we have 200,000 collectibles. Then interest income is based on the unpaid balance. Since prior to the collection, our unpaid balance is the 600,000, the basis of the interest income is the unpaid balance of 600,000 times 12%, that would be 72,000. So our debit to cash is the total collection of 272,000. For 2021, our annual collection will be the debit to cash, 248,000. Notes receivable credit is the same, 200,000, but interest income is 48,000. How did we arrive at 48,000? It is simply the 600,000 minus 200,000, that would be 400,000, times 12%, that would be 48,000. So as you can see, the paid balance is decreasing. So the unpaid balance for 2021 before the actual collection of 200,000 will be the 400,000. How did we arrive 400,000? Again, the 600,000 minus 200,000. The 200,000, the previous collection in 2020. So for 2022, that would be a debit to cash, 224,000. Notes receivable still at 200,000. Then credit to interest income of 24,000. How did we compute 24,000? It is simply the final collectible of 200,000. How did we arrive 200,000? 600,000 minus 200,000 in 2020 and another 200,000 in 2021. So that would be times 12%, so 24,000.